Okay, and our third speaker today, our third entrepreneur, is Henry from BirthStar.
Okay, well, thanks very much. Following on from that, in a way, BirthStar is about widening that net even broader, not just people who want to trade, but people who are too afraid to even learn about investment. So we're actually trying to reach out to the 27 million people who don't have any form of long-term investments. So let me tell you about BirthStar. Just my background and my partner's background, we're both actually from the hedge fund industry. I started at Schroders, then at Thames River Capital, then worked for a hedge fund for the last 10 years. And my partner was in the Goldman Sachs prime brokerage. So we're both from the investment world, but from the opposite end of the market. Very high return focused, very high fees, and very niche. Minimum ticket sizes, £1 million. But when I started a family, it occurred to me that investing was pretty complicated, even if you knew a lot about investment. And so I set up something called the BirthStar project in 2012, really to help asset managers and intermediaries develop investment solutions that were easier for their customers. The reason it's called BirthStar is because the only thing that stays with you throughout your life, your income changes, your job changes, your investment appetite changes, the only thing that's fixed is your year of birth. So the idea is about creating age-based investment solutions. So I think, as we're hearing earlier, personal investing is way too complicated, regardless of your knowledge or ability. And the whole idea for this started when I had my own family, and I was trying to work out how do I invest for my kids? How do I make them have a better future? You go online, there's thousands of investment funds to choose from. You don't know whether to set up an ISA account or a SIP account. You don't know how to build your own portfolio. You call up an IFA, they're trying to sell you something. It's complicated, it's unnerving, even if you've got the investment qualifications to hand. And I found myself building complicated spreadsheets, amortizing the £5 trading cost over a 15-year estimated holding period, building a portfolio asset allocation model based on David Swainson of the Harvard Endowment Fund. And all of this was for a £100 a month investment into my kids' child trust fund. And I thought there's got to be an easier way. So the problems we have in the industry are there's too much choice. We don't actually know what to do. We're bamboozled by choices as we enter that investment world. There's not enough guidance. You can look at money advice service, you can talk to your friends, but there's nothing really actually saying, let me hold your hand, I'll get you from A to B. My personal view is fund providers, the kind of retail asset managers that you're familiar with, they're trying to solve the wrong problem. They're saying, we've got a really, really good kind of Asian equity fund. Right? Okay, what do I do with that? And they say, okay, no, we'll give you something else. We'll give you a really, really good income yield fund. It's like, okay, well, how does that work for me? So we think the kind of fund providers are busy thinking about sort of 10-year-ago problems of how to make really good funds to fit inside someone's asset allocation. Whereas what they should be thinking about is, how do I solve your problems? And my problem is I want to get from A to B for my pension or for my kid. The other issue, well documented, pre-RDR, is that the investment industry is what I call opaquely expensive. You know, you have the AMC, but the actual cost is obviously the TER, but that excludes the trading cost which are on top, which you have to know the portfolio turnover rate. So it's like, okay, so we just don't know how much it costs. So we need to kind of smash through that barrier as well, but obviously the regulator's working on that one as well. The other issue is that it's over-intermediated. You know, you have to go through so many layers to get to the kind of investment bit. And in the olden days, and the standard return assumptions that the regulator used to use would be, for a long run investment, you get somewhere between 5, 7 and 9% per annum. Now, 7% per annum, assuming inflation 2%, 5% real returns. In the olden days, that might have been realistic if you're investing from the post-war era, 1945 to now. But nowadays, that's just not on the table. No one's offering you that. So we live in this era of what's called depressed real returns. And if you assume that long-run real returns, based on where kind of current expectations are, is about 3%, and the average retail fund cost in the UK is about, once you add in the all-in bit, is about 2%, it means the fund industry is taking about 2/3 of investors' money, and the investor gets to keep 1/3 for their outcome, like for their pension, for their kids' school fees, whatever it is they're saving for. And we just think that relationship is fundamentally skewed. So we think there's going to be massive compression on fees so that customers get to keep more of their returns. So as I said, personal peer group experiences, you know, this idea really started back in 2008. First kid, sitting around the table, lawyers, accountants, got really interesting friends, and we're all trying to answer the same question of what do we do? What do we do? We've got 100 quid a month to invest. What do we do? So they thought there's got to be a simpler way. The other thing I think, and I think the previous presentation touched on it, is that investing is a niche hobby. We call them enthusiasts. The traditional investment market, the entire investment industry is focused towards what we call enthusiasts. If you think about it, people enjoy tinkering around with investments. They enjoy reading the Investment Chronicle and the Investment Week, and they avoid following the FT, what's happening with BP's share price. It's going up one day and down the next. This is the enthusiast market, and it's a real minority. Very important, very affluent, but it's a tiny amount of people. So if we're there's a whole government agenda about how do we get more people saving a bit more for more in the future, which is the other way of saying we want people less on our books in the future, but that's the kind of demographic issue they've got to deal with, then you've got to make things easy. So if you think about the car industry, the enthusiast is of, probably you remember maybe your granddad or your uncle, Saturday you'll be spent, fiddling around the car, changing a bit of the engine, going down the garage, bringing back another wheel or part, sticking it in, and then people enjoy tinkering around with their cars. That's what you did. It was a relaxing thing, and you read about it, and you've got some magazines, again, a niche area. But actually most people, and the real successful players in the car industry, are people who design cars that can be incredibly complicated underneath, but they're very easy to drive. So you think about the Audi, you get in, you point, you press, it goes where you want, it even parks itself. So, people don't need to know about cars to drive a really well-built car, and we think the same applies to funds. You don't need to know how investments work to have a really well-made investment. So the twin-track response to this problem has been twofold. One is the regulatory bit, which is RDR, term familiar here. There's also auto-enrollment, which is creating 8 or 9 million new savers who will have to have a pension scheme through company pensions. There's a simplified advice and non-advised propositions emerging. A lot of the new startup players in the market coming in with a kind of algorithmic or robo-advisor, as they're called in the States, type models that make investing easier, and we're looking to power those solutions as a hint going forward. There's something called freedom of choice, which is the recent budget whereby the government's letting you do whatever you like with your pension. And there's this drive towards what's called simplified financial products. And they said, well, we'll start off with bank accounts, because that's pretty simple. Then we'll do savings accounts, because that's a bit more complicated and still quite simple. And the investments thing, we'll work on that one. So there is an effort to kind of make things easier. So putting a provider hat on, what kind of solutions are we seeing in the market? So if you look at the States as a test bed, as it often is, the thing that's emerging as a solution of choice are what called outcome-oriented. So again, forget your niche Asian equity or Estonian timber fund, that doesn't get you anywhere. It's about outcomes, something that delivers me a journey. Critique investment solutions are what are called behaviourally adapted. So let's not think about what people should be doing, and let's not try and educate people what they should be doing. Let's see what people actually do and design solutions that fit around known human behaviour patterns. So behavioural finance is, and we're at Barclays Accelerator, so they know a lot about this. Behavioural finance is key to delivering better consumer outcomes. You have to assume that people won't read what you send them in the post. You have to assume that they won't check their account every month. You have to assume that the average review cycle for a pension in the US, for most institutional pensions, is about 10 years. People think, oh, I should check that, shouldn't I? Well, next time. 10-year gap is the average review cycle. So you have to design things that kind of self-drive a little bit. They have to be technology enabled. You have to have the kind of ubiquitous information online. It has to be a pleasant kind of user experience. And the US example I say is bringing those ideas all together. So this is probably getting a bit over complex, but we're saying what we're doing, what Burstar's doing, is we're actually helping both new and traditional direct-to-consumer providers enhance their solution. The way we're doing that is by trying to focus on a winning formula. And the winning formula that we think is there for those investment providers who want to either launch a new service, I know there's one in the room, or one who's already launched them, is to focus on the lowest cost of delivery at lowest cost to customer with a great service, experience and outcome. The outcome is the bit the regulator is concerned about. Cost and value are the things that we think we deliver. We think there are 4 key ingredients to think of for any aspiring direct-to-consumer startup. And there they are. And we're here to make things easier for those providers coming into the market. If you want to find out more about it, do come and chat to us afterwards. We've got some a video and some stands, but questions?
Great, thank you very much, Henry.
How much of the advice are you seeing is still going through advisors rather than coming through a site like yours? And again, it's a difficult question to answer, but
yeah, I think for the legacy business, for the existing retail business, a lot of it will continue to be intermediated. But I think even the advisors are realising that some of their clients want to transact on a non-advised basis. They just want to top up their ISA. They want to do their kids' SIP or something. So we think it's more this kind of hybrid model whereby there has to be the advisory channel for big things like I've just inherited some money, or I've got ready to do a big financial plan. But there's still that non-advised element, and so people need to be able to toggle between these 2 different services. For the mass market, there's obviously this non-advised proposition for people who wouldn't be able to enter the advised market. So we expect that intermediary firms who offer advice will be launching these non-advised arms to incubate future client banks.
So I was interested in your reference to behavioural economics. It's people that invest in funds often don't invest in the cheapest fund. They often invest in the fund that's performed well for the past 3 years.
Disaster.
How are you going to try and change that market behaviour? Because that would be a real benefit to those investors.
Yeah, it's a very good question, and it makes my blood boil when I see those leader tables of top 5, worst 5. So this is called performance extrapolation. That is the behavioural tendency, and it basically means chase the winners, which usually means they're sure to fail. So the way we're doing that is actually trying to remove the whole fund lexicon out of the equation and actually focusing on outcomes. So the engine that we've worked with, AXA and their Arctas, which is an AXA and fund business, is to create what's called target date funds. And target date funds are not a conventional fund of like top 5, worst 5, Estonian timber, whatever it is, Asian equity. It's a journey fund that's labelled by the target date. So if you're an investor, let's say saving for your pension or saving for your kids' university fees, you think, I need to save this much, my goal is in 2035, I just buy a target date 2035 fund and it will get me from A to B. So we take it away, we don't talk about equities, bonds, alternatives, all this kind of complicated stuff. We just label the funds by their target date, and that sets the journey by which they can get from A to B. So, in the future, you might have target date fund rankings of this target date fund did better than that target date fund, but at the moment, it's a total opposite to the way the fund industry works at the moment. The fund industry is focused on building blocks. Where it's going to move to, we think, is about building solutions. So by bringing that target date element, it makes it solution-based.
Thank you.
Final question.
Henry, in terms of your sales strategy, how much do you think is about the success is based on creating consumer awareness, so creating demand rather than actually trying to force it down the throats of the asset managers to supply something that they actually don't see demand for?
Yeah, we haven't forced down anything down the throats, so we're lapping up with both hands. No, it's a good question. We are, what we're doing is actually providing an engine inside the direct consumer proposition. So we are working with the investment providers. There'll be an announcement on Tuesday you can look forward to. Please look out for that, of someone who's going to be launching a new online service. We're working with the traditional investment providers and the new ones. They are the ones who are fighting the last mile. They're the ones fighting for customers. They're the ones who've got to have the distribution strategy in place. What we're providing is the interface, the interactive tools, the apps, and also the funds through our partners that deliver the investment engine in a very scalable and low-cost way. So, we obviously help them develop that distribution strategy, but we're not the last mile. Our partners are the last mile, and we're looking to grow our partners' business by plugging in our IP into their front end.
I just need to clarify something. Are you actually aiming at retail investors?
Ultimately, yeah. So the funds that we've worked with creating, which are called the Arctas BirthStar target date funds, they are aimed at retail investors, and we are plugging in our tools and interfaces and the funds into distributors, i.e. online investment platforms who target retail investors. So we are the wholesaler to the intermediary firm or the front end or the website, and that website is targeted to the customer.
Okay, so the image is here on your last slide. That's your current website aiming at retail investors, right?
Yeah, so retail investors can buy our funds by going to the Share Centre, Hargreaves Lansdown, Strawberry, Alliance Trust. They can buy those funds from any of those providers. We design those funds. They've been built by Arctas. They're managed by Alliance Bernstein, which is a $480 billion global asset manager, and they can buy those funds from any fund supermarket. But where we're looking to do strategic deals is where we go in and help those stockbrokers, if you like, redesign their websites to make it outcome-oriented, behaviourally adapted, technologically enabled. So we effectively, like Bucks, we build the front end, we build the investment engine, but they are the ones doing the distribution.
Anyway, Henry, thank you very much.